I would like to welcome you once again to the financial reporting class online support. Today, I would like to focus on intangible assets. And again, please ask questions where you're not clear. The standard IS-38 guides and informs the accounting treatment of intangible assets. So what is an intangible asset? This is an asset without physical substance, which is capable of being disposed separately from the other business assets. It is an asset without physical substance. Do we have examples of intangible assets? Yes, we do. Intangible assets include goodwill, purchased goodwill for that matter, brands, license, as well as software. When I say intangible assets, I'm referring to those assets that are purchased in most cases, or intangible assets which are not purchased cannot be recognized because those lack a reliable measurement amount. So just like in the last session that we did, intangible assets are recognized if value can be traced, and if those assets can be reliably measured. Let us remember that. Under measurement, initially the asset is measured at cost. Subsequently, we can always run with the fair value or the cost model. Now, under intangible assets, we also have gradual loss in the value of the asset. The gradual loss in the value of an asset under this very important discussion is referred to as amortization. This is a systematic writing off or allocation of the cost of the intangible asset over its useful economic life. So intangible assets with a finite life should be amortized over the expected useful life. Impairment is applicable under intangible assets, and the standard is quite clear. All assets, all intangible assets without a limited useful life or with an indefinite useful life, such as goodwill, should not be amortized but must be tested for impairment loss once in a year. Let us also consider the all-important distinction between research and development expenditure, something that gets to affect us under this very important discussion. So research refers to initial investigations undertaken in order for us to discover new ways of doing things, to discover better ways of manufacturing our product. Remember, improved products are good for our future markets. Now, development expenditure, on the other hand, refers to the application of research findings. If you can benefit from your research findings, then you are hitting what we call development expenditure. Now, why make a distinction between the two? Because research expenditure is a revenue item, so it should be expensed in the statement of profit or loss. In other words, we expense research and expenditure, research expenditure rather. But development expenditure should not be, should not necessarily be expensed. Managers can capitalize this cost in the statement of financial position in accordance with the Pirate criteria. All right, so now when you discuss Pirate, the following should be considered. Number one, PIRET stands for the following. There must be a probable flow of economic benefits from your development project. There must be reliable estimates. So I'd like to get these two and remind you this one. Let me get back to that. The first option and the last option are, the recognition criteria for any normal asset. So for an asset to be recognized, there has to be the probable flow of economic benefits as well as reliable measurement. In this case, we're talking about estimates. The enhancing conditions for us to recognize development expenditure are listed here. There must be an intention to complete, use or sell the asset that comes out of your development project. There must be adequate resources, including cash, to start and complete your development project. You must have the ability to use or sell the output of the development project. Of course, that also speaks to the legal, authorization as well as the demand for your products. Then there must be technical feasibility. We must have, let's say, an IT specialist if we are going to come up with an accounting software. Thank you very much for listening in to this introduction on intangible assets. I'd like to see if we can practice some questions together. So I'm going to the revision kit just now, trying to discuss with you briefly, and then I am going to close. Right, so let us begin with that first question, and I hope that you are ready to think with me. We are told in question 33, G company is developing a new product and expects to be able to capitalize the cost. Which of the following would disallow the capitalization of the costs? Okay, so number one, development of the product is not yet complete. No, it needs not to be complete. So development expenditure needs not to be complete for us to recognize it. Then B says no patent has yet been registered in respect to the product. This speaks to the ability to sell the product in a safe way. There's no need for us to wait for the patenting process to take place before we can recognize development expenditure. That can always take place in the near future. No sales contracts have yet been signed in relation to the product. That is option C. I think that can still wait. We can always do this in the near future. But this says it has not been possible to reliably allocate costs to the development of the product. And I'd like to get this one because it is in direct violation of the letter E, reliable estimates. Let us remember that. Thank you. Let us try to see if we can go to another question. So I go to the requirement. It is always important to look at the requirement. What amount to be charged to profit or loss? I'm here now. This is the requirement. What amount to be charged the SPL for the ended 30th September in respect of research and development expenditure? So let us read together. This company, a Sorio company, had 20 million of capitalized development expenditure at the cost brought forward on that year start 1st October X7 in respect of products currently in production, and a new project began on the same dates. The research stage of the new project lasted until 31st December X7 and incurred 1.4 million of costs. From that date, the project incurred development costs of 800,000 rather per month. And on 1st April 2008, the directors of our Soria company became confident that the project would be successful and yield a profit in excess of cost. So that's a place where we're able to see development expenditure setting in. The project was still in development at the end of the year. Capitalized development expenditure is amortized at about 20% per annum using the straight line methods. Right, so it's a fair question, and I think that we can always work it out in Excel. I hope I can open this relatively fast so that we can, save some bit of time. Right. Okay, so I would like you to be proactive in terms of responding with questions. Again, these studies, they're quite involving, and as I do this video, I know that you still need to come up with questions. You still need to come up with questions. Okay, so let me just try to do some bit of work here. If I may just increase my space there, I think I'll be much more better. Okay, so the question is suggesting to us to find the charge in the SPL. What will be the charge in the statement of profit or loss? So, well, the first charge will be amortization based on the opening balance in the books. We are told we are opening with 20 million. Then you divide that by what's the policy of the company, is to be amortized over 20 years. So I can multiply this by 20 years, which is 5 years. They're about 20% in 100%. So again, we do the necessary for the sake of understanding. So that's what we have there. Allow me to put some zeros on top there. Okay, let me just do it again. Okay, so interesting, isn't it? That's what we have there. Then we are told that for the first few months, from about October, if I'm not mistaken, to December, we were not. Let me just check the question. So the research stage of the new product lasted until 31st December. So all the costs incurred under there should be treated as an expense. So how much were you spending? Okay, you were spending 1.4. I hope that you can see that figure there. So let me just push that one directly. Say 1.4, and then finally we are told that on first April, the directors of Asoria company became confident. Okay, so that one is okay. But we are told that from that date, from which date, 31st December, the project incurred development cost of 800 per month. But on 1st April, the directors became confident. So we're going to calculate the number of months between January and 1st April, which is about 3 months, multiplied by 800,000. So again, we've got research expenditure. What do we have? I'll have to multiply that by about 3. Let me just check that one again before I get excited. So yes, it is 1st April. So if I do the maths, I think you can see with me that we have got that amount there, 7/8. Okay, so let's check our workings. I think we can see 7/8 there as the amount that we're looking for. Right. So let me do this last question and then I'm going to close. Identify whether the following internally generated items are eligible or ineligible for capitalization as intangible assets in accordance with the standard. 1. Customer list built over the last 10 years, trading updated for the customer currency preference. Is this qualifying? I don't think so. Ineligible. Why? Because this is an internally generated asset. Then the next one, specialized tooling for a new product developed by the business. So specialized tooling, these are the assets that we use to make new products, and I think clearly we are able to get benefits from there, so that is eligible. Next, working version of a new machine that uses new technology used for testing of the prototype apparatus. I think we can get this one as well, eligible, because we are getting economic benefits from that. But the last one says a title, heading, font, and design of the front page of a major broadsheet newspaper. This is an example of a masthead. So it's ineligible. Why? Because it's an internally generated and recognized asset. Thank you very much for listening in. I would like you to ask questions on the other side. We want to proceed to do other things.